So welcome to the VIX Hunter Volatility Series, where we take 10 to 15 minutes an episode to talk about how to understand this broad concept of volatility as an asset class. The word volatility can mean a lot of things, but a lot of clients come to us, they ask us, what on earth are you guys talking about when you go on about VIX futures curves, contango, backwardation. Now, a lot of them don't care, and we totally understand that. After all, you're paying for a service so that someone else can take on the hard work, watching the signals. A lot of you have day jobs and can't be bothered, and that's certainly what we're here for. But if you are curious and you want to follow more of the details in our updates, this series should be very helpful. This stuff can sound a little like a different language, and really is in a sense. Options and volatility are multi-dimensional instruments that have a lot of moving parts. And apart from the obvious issues of having more things going on with a strategy, why would this be particularly important with volatility? Well, the parts can move at different rates depending on the environment, your expiry dates, proximity of your strikes to your underlying. So these parts are ebbing and flowing and flexing in different ways, and very importantly, the payoffs can be asymmetrical. I'll say that again. In the world of volatility, the payoffs can be asymmetrical. And so a very simple example of this would be having a short put position on a stock. When the strike, in this case $100, is far below where the stock is trading, which is at $110, that put is not going to fluctuate very much. It's not going to react very much, as much to a move in the underlying. But as that underlying moves down, as the stock gets closer and closer to that strike, the put becomes more reactionary to moves. So the speed at which that put, or the volatility pricing, is going to change much more quickly. And another way to sort of look at this asymmetrical payoff is, in the end, really you can sell a $1 put, and what's the most you can make from that put? So if you've got a option harvesting strategy, selling puts, calls, whatever the strategy might be, the most you're ever going to make from selling that $1 put is $1. As the time value erodes and goes to zero, you're going to make $1. But can that put ultimately be worth $10? Sure. Can it be worth $20? Absolutely. So, you know, whereas with a stock can go up or down $5. You know exactly what you stand to make or lose. But with a short option, the payoff is not linear. So when you're short options, you have a limited potential for gains and theoretically an unlimited room for losses, or at least, you know, down to a value of zero in the underlying stock for this put. So these concepts are going to be very important to us as we explore how volatility affects products like VXX, SVXY, UVXY, etc. Later in the series, when we talk about feedback loops and the tendency for volatility to continue in a particular direction, right? So when things get ugly, they tend to get uglier, and when things get calm, they tend to get a little bit more calm. So these concepts become a sort of critical thing to respect, and it really speaks to the importance of money management. When we have a product that can move in this non-linear fashion, good money management becomes very, very important. If you think about it, why do most traders lose money? Well, it's not from gains, right? That's the easy part, although, you know, knowing how much of a gain to take is certainly a skill to have. But the trouble comes from not knowing how to handle losses. And in the world of volatility, losses and gains can accelerate. And so we have to know how to mitigate those problems when things do start to go wrong. So the more you hear about a few of these concepts, and we're going to keep repeating some of them because that's often the best way to learn something, is by repetition. But the more we delve into these concepts, the more you're going to understand what makes volatility tick, what makes volatility as an asset class work, and you're going to understand what it is we're looking for in the strategy, and we're going to talk a little bit about how to find some of these interesting things. So let's take another step back and look at what really makes a trade better than another trade. And so this could apply to any kind of trading. It doesn't have to be option trading, volatility trading. I mean, we can't really tell the future, right? So my crystal ball probably isn't any better than anyone else's, but really, what are we kind of striving towards in any kind of strategy? It's edge, right? It's the concept of finding a little bit of edge in a strategy. So it kind of reminds me of when they say the three most important things in real estate are location, location, location. Well, in trading, it's really about edge, 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 and maybe a little money management as well. We'll throw that one in there as well. But it's really about finding that little bit of edge in order to do better than the benchmark. And they call that generating alpha. How can you use your knowledge to do a little bit better and outperform over time? And that's what fund managers are trying to do. That's what they're trying to use in order to get ahead. This concept of edge. And of course, the vast majority of them have underperformed the index over the past 10 years. Active management typically doesn't do very well. And hopefully that's one of the reasons you're listening to us, to take control of your own financial destiny. But perhaps that's a story for another day. But again, edge, like volatility, is not a very specific term. It can come from anywhere. It can be fundamental things, like, you might think a company's cash flow is improving, or maybe you like the new look of McDonald's restaurants after that big push to renovate all the restaurants. That could be your edge as well. That might make you want to buy McDonald's stock. You might like the chart on Intel. Let's say it has good relative strength. Well, that's edge as well. You might think Tesla, for example, is far and away the leader in what it does, and that's a relatively strong storyline. Is Tesla's valuation the edge in going long the stock? No, that's not really the edge. By most measures, it's overvalued, but the edge is in the positive momentum and the storyline and the big head start they've had. There's massive short interest in it. That's propelled it higher. So, we start to touch upon things that aren't as tangible. Is sentiment edge? Well, absolutely. In fact, it's one of the key elements to volatility trading. And learning to read sentiment is going to help us find edge over time. So, there's this idea of the efficient market theory. It says the market knows all things at any given time. But is that really true? Well, I'm never sure about that. There can be many competing narratives. We often see a narrative like, perhaps the U.S. debt ceiling problems that we had there a few years ago. We knew about it. The market ignores it until it doesn't. And then the market decides to reset based on something it already knew for some time. So how does that happen? Well, there might be another narrative, and that narrative is in control. Another sort of supply-demand function was in play, and it needed to run out of steam and play out. Maybe there was momentum in the market, investor positioning was weak, maybe investment advisors were pushing clients into stocks at that point, and sometimes not because they want to push their clients in, but because they're worried about missing out on a big run in the market. But eventually another narrative took over. So edge can often come from things that you can't see, but often it can come from something mathematical, and it can come from something less tangible, like sentiment. And when we're talking about volatility edge, we're very much talking about something mathematical a lot of the time. An instance perhaps where someone is over or underpaying for something. And the great thing about the edge that we see in the vol products is that around 80% of the time, the mathematical edge is in being short volatility. Now, the other 15 or 20% of the time, we need to make sure we either are taking advantage of the volatility or we're steering clear of it. But a lot of the time, there's this kind of head start in these volatility products. So what we do is we're looking for signs, we're reading the picture, we're looking at the VIX curve, we're looking at many other things in order to formulate this picture of where the edge is. And so we've developed the system to help identify some of the things that over time have warned of more volatility, or simply are indicating that there's a strong likelihood that volatility will remain high or remain low. The math, or lack thereof, depending on the situation, will help us to identify what could be going on in the market. We're often looking at two things: signs that things are going to stay volatile or get more volatile, or signs that things are going to calm down. So a lot of what we do is really in looking for signs out there. Now, is this an exact science? No, of course not. There's some art to it, but having traded volatility for longer perhaps than I'd like to admit, I can tell you that history does repeat itself, in particular in the world of volatility. The market can absolutely drop drastically or rise drastically. We don't know. Is it going to go higher? Is it going to go lower? We're not sure. But volatility levels will have an extremely hard time staying extremely high for very long. And so why is that? Well, volatility, remember our earlier point about sentiment. Volatility is a reflection of sentiment. It's a reflection of human nature. It's a reflection of how human nature plays into investor sentiment and market behavior. And these things are things that repeat over time. And so we're going to talk about concepts like mean reversion as a great example of this. And we're going to learn to respect certain important signs that we're seeing out there. And we're going to learn to recognize the mathematical edge that might be prevalent at any given time. Because think about it, if you already have a mathematical edge in choosing to go long or short volatility, that can be a very powerful advantage if you've already got that head start in the product. So, you know, for example, you might have this idea about where the VIX or the market is going, but you need to respect the underlying math the market's giving you. These are embedded headwinds and tailwinds in these products that we need to recognize. Sure, the VIX might go up, but you still might lose money on a position in VXX. Why would that be? Well, that's some of the stuff we're going to get into. We need to learn to read the VIX futures curve and where spot VIX is. A picture is definitely worth 1,000 words when it comes to the volatility landscape. So I think that's good for today. We focused on some of the less tangible things because I really wanted to impart on you how important our conceptual approach is towards volatility. We really have to build a foundation of understanding on a very fundamental level what volatility means and where the edge lies, even before we begin to take an approach from a directional standpoint. So next week we'll delve into the VIX futures curve itself, and so we'll talk to you then. Thanks for listening.